Hey traders, this is Blake Morrow with Traders Summit, and it's Friday, and I have Jim Welsh here is from Macro Tides, as we always do on Friday. We get to break down this crazy week. I'm worn out. How are you, Jim?
Well, we talked about it just before we started, the tape, and we're both like, some weeks they say they're 5 days, but they feel more like 15.
Yeah.
So obviously this is a very intense week, a lot of volatility, a lot of things moving in different directions, and some of the charts, as we'll discuss, to me are a little unclear, and it's important for me to acknowledge to myself when things are unclear. It's like, hey, don't try to put a square peg in a round hole. Just wait for the markets to kind of do whatever they're going to do, and then they get clear again. It will happen, but that to me is one of the signs of maturity.
Yeah.
Where I'm not always trying to figure it all out and figure I got it and push the envelope. There's times where it's like, okay, a lot just happened this week, and there's balls in the air, and they haven't come down completely yet.
That's a great for the traders listening in who really understand that concept or don't understand that concept. I had similar conversations this week about the Great British Pound, since I focus a lot on currencies,
Yeah.
I'm kind of lost here, but it's okay because those views will come back into line with your macro backdrops, which Jim will be very good about outlining, and the technical formations that might reinforce that. But Jim, this week you brought the yen, and you brought the chart to our attention. I'm excited that you're going to cover that. I know it's been in everybody's view this week, as far as the markets go. So I'm glad that you got to do that. So make sure you all stick around for that. And I also want to mention before we get started, Jim does a great job here every week, exclusively here on Trader Summit, just walking you through everything that's happening in the market. So if you guys and gals appreciate what he does, make sure you give him a thumbs up. Make sure you email him, jimwelshmacro@gmail.com. Request one of his most recent publications from Macro Tides, and get in touch with him and tell him that you found him here. So Jim, let's go ahead and jump into what you want to talk about this week. And we're going to start off with the ISM services. So tell us why this is a big deal. I mean, it bounced back, and it kind of, I don't want to say that the market had a weird reaction. You want to talk a little bit about it?
Yeah, I mean, when we talked last week, and what I wrote about in last month's Macro Tides was that when the ISM services came out for July, it was going to rebound, because you can see that huge drop that took place during June. And relative to what we know was going on in the economy, to drop, over 5 points in 1 month, so it was almost an easy call to say, guess what, folks, this is going to rebound. And given late last week, everyone was started to worry about a recession because of the weak employment report. The ISM manufacturing was very weak. The SOM rule, because the unemployment rate ticked up. Oh my God, it's signaling a recession. My thought was it would bounce, and it would provide some sobriety to the, oh my God, the sky's falling type of thing.
Yeah.
Now, in some respects, because of what was going on in Japan with the yen, their stock market down 12%, the ISM number came out on Monday when all that was going on. And it came out about a half hour into the trading day. And the S&P responded and rebounded after that report. And again, to me, this was important because I think the reaction to the SOM rule, signaling, oh my goodness, we're already in a recession, was way overdone. And that, even though it bounced, but you can look at this, if you drew a trend line that connected the mean, it's trending down over the last 18 months or so. So it's not like, oh, wow, the coast is clear, but it's zigzagging lower. And to me, this would call into question the idea that the economy was already in a recession. And I think it helped on Monday in terms of bringing the S&P was down almost 250. It got to be down 95. I think it finished the day down 160. So there was obviously some residual selling, but I think this provided some stability earlier in the day when it was kind of needed.
And one of the other things that really provided some stability to the markets this week was the unemployment claims that you see here. Uh,
Yep.
and I mean, everybody who's, myself included, was fearful we were going to tick above, 250, 260, and then
Right.
it was really going to be bleak.
Yeah. Well, what we talked about last week was the continuing claims, and they're 1 week behind the weekly claims. So, in other words, this was for August 3rd, and the continuing claims are for the last week of July. So, what you can see, and this is what we discussed last week, since mid-May, you can see obviously an upward trend in on balance the unemployment claims. And what I showed last week was over since 2018 and 19 and 2023 and so far this year, there's been a seasonal pattern from mid-May to mid-July where claims go up. And it'll be telling. 1 week does not erase what I think is coming, but I just felt that the seasonal pattern would likely start to show claims coming down a little bit because it's been so pronounced in those other years. And on Thursday, claims came down. When that number was announced, the S&P rallied 40 points.
Yeah, yeah.
I mean, again, relief that, oh, wait a second, we thought we were in a recession last Friday. And it's ridiculous because unemployment claims don't usually garner a lot of attention. But as you just noted, there was much more attention on the unemployment claims this week because of the employment report, the SOMRU last week. So going forward, the next 4 to 6 weeks, I think claims are an important tell in terms of the labor market and obviously then the economy.
So the next chart that you brought up here, and I want to make sure I got the right one. Explain to us what this chart is showing us.
Basically, it's a diffusion index. So it's showing if you have 60 sectors up and 30 sectors down, it would show a percentage as a percent. Well, when it's 50-50, as it was last month, July, or 49.6, I believe, it shows that there's just as many sectors that are letting people go or not hiring, I should say, versus sectors that are. So the erosion in the labor market is continuing. It just comes down to, I think there was an overreaction to last week's employment report, but the trend is unmistakable. And so my take has been we will see more slowing in the labor market as we go into year end. I just think the SOMRU hype, kind of was overdone last week. But saying that does not mean we want to ignore the message of other labor market indicators. And you can see when it drops below 50%, in 2001,
which we are, yeah.
Recession. And right. 2000, late 7 and 2008, a recession. So I still believe we're moving toward a recession. It's just going to take a little while more, but this is one more sign that the labor market is gradually weakening.
Okay. All right. Well, the next couple charts you brought, you in your advice, we're going to kind of scroll through them a little quicker.
Right. Yeah.
So tell us what we're looking at here.
Again, it's more of what we just saw. What this shows is the annual increase in hours worked. And obviously you can see in 2021, government sent a lot of money out, the economy reopened, people went back to work, it had a huge explosion. But again, the downward trend is pretty unmistakable. This is Scotiabank. This is their estimate for the third quarter. They've got it negative.
Okay.
Whether it's negative or not, again, the downward trend shows us that hours are being cut back, which is why we've seen an increase in part-time workers and a decrease in full-time jobs over the last 12 months. So this is just another sign of, okay, people overreacting to the SOMRU, but the bigger picture is the labor market is softening, and I think it will continue to soften over the next 3, 6, 12 months.
All right. And the next chart that you brought is business bankruptcies. Tell us about this. I mean, it's not real. I don't think it takes a rocket scientist to figure this one out, but it doesn't look good. How about that?
Well, look at the trajectory.
Yeah.
And you can see we're above where it really kind of trended in 2016 and 18 and 19 and so forth.
Yeah.
And one of the things we've talked about a lot over the last year is tightening lending standards. And small businesses, they can't go to the public market and sell bonds. They borrow from banks. And banks have been raising the cost of money, but they've been cutting back on availability of money. And over time, as the economy starts to slow, businesses can't make ends meet and they wind up going into bankruptcy. They either close forever or they go through a reorganization. But either way, again, under the surface, we're seeing more signs that the economy is softening. There's a bifurcation in the next chart, I think we'll get to it, between the top 40% and let's say the bottom 40 to 50%. So the bottom 40 to 50% have gone through their savings. The top 40% still have savings because they always have savings. Also, assets are up 40%, net worth. Well, what are those assets? House prices and equity prices. So the top 40% are living in a different world. The people at the bottom 40, you can see they're stretched. They've been relying on credit cards. Now they're falling behind, and also on auto loans. And the thing about auto loans, which is going to be interesting, is if in fact we go into a recession, more people get laid off, a lot of car loans now have a value greater than the actual value of the car, because somebody went out and bought a new car. The prior loan was underwater. In other words, they owed more on the old car than what they were going to get a credit. They owed $6,000. They gave them a $5,000 credit on the new car.
That's generous.
So yeah.
That'd be generous.
Yeah. But the point being is that small or banks have exposure in this area. And that's why I think next year could be really difficult for banks, not only because of commercial real estate and office, apartment buildings, but also credit cards, auto loans, because people are upside down. And when you're upside down, take the car, and the bank's not going to be able to sell it and cover the loan balance. Yeah. Now, this isn't bringing the banking system down, but again, it underscores the pressures that I think are going to come to bear. And when the banks are under that kind of pressure, what do? They raise lending standards even more. So it's important to understand that banks are pro-cyclical. When the economy is good, they'll lend like crazy and they'll lower their lending standards. Then the economy rolls over. They start to pull back. And when it goes into recession, they pull back even more. Well, they make the downturn deeper. So banks are pro-cyclical and they're always behind the curve. So
that's something that everybody's got to understand, that simple concept. I know this is going to be a little bit different than what you normally do, but this has been I've called it the linchpin of the market this week. And it's really just kind of moving everything. What do you make of this? And tell me exactly what we're looking at, because I know what we're looking at, but I don't think everybody understands what we're looking at.
Sure. I mean, if you look at a long-term chart of the yen, to me, as it was getting down to those lows, you can count 5 waves down from much higher prices, right?
Yeah.
And so typically retracement rallies will retrace some percentage of the big decline.
Yep.
And one of the targets always becomes wave 4 of lesser degree, which is at this point 7377. So when I look at this, one of the things I try to do when it's there is find wave 3. And that's always where the most energy is. It's kind of like the recognition where everybody's like, holy Moses, it's going in that direction. And in this case, we know there were enormous short positions. You and I talked about this a couple of weeks ago. I showed a chart of short positions, or I had it in my letter 2 or 3 weeks ago, short positions, and that we would see short covering come into play. Well, obviously, that over the last 2 weeks, that was a big factor. From a pattern, I look at this and say, all right, it's clear to see 1, 2, that huge move we saw to the highs on Monday. Looks like wave 3. You've had a pullback for wave 4. So this chart implies that there's a rally coming above the high from Monday, and makes a run up towards wave 4 a lesser degree. And that's where I have 7240, 7350 as being a potential target. At a minimum, I would expect to see a retracement. In other words, maybe the whole move's over, it topped, but you're going to see a retracement from that high on Monday to the low we saw yesterday of some magnitude. Well, if the yen goes up to a higher high, we're going to see, not as extreme as we saw on Monday and Sunday night, but we're going to see people like, oh, in other words, I don't think the yen carry trade has been completely unwound. And people got a respite over the last 3 days. The Bank of Japan said, you know what? Oh, we're not going to be raising rates when things are crazy. Tell me something that's not obvious. Okay, thank you. But I just think the pattern here suggests, Blake, as you noted, if you're not watching the yen, you're missing at this point in time something that's really important to the global financial markets. And so the pattern to me implies that it's going to at least have a decent bounce to recoup 618 or some percentage of the decline from Monday to yesterday's low. Or I think more likely the pattern implies it's going to take out Monday's high. When that happens, I can't imagine that financial markets aren't going to react like we saw on Monday, just less extreme, but they're going to react, I think, negatively, where equities go down, bonds rally. The yen is only 13% of the dollar index. So, the dollar can, in fact, actually move higher if the yen does bounce, if other currencies are weaker. So, it doesn't maybe dictate what happens directly with the dollar as opposed to the euro, which is 57% of the dollar index. When it moves, it definitely directs the direction of the dollar.
Yeah, and I want to remind people that, well, I would just want to explain to people that aren't so educated in currencies specifically. It's not just the dollar yen that's moving, which this is the inverse chart of the dollar yen, which is the base, tends to be the base currency that everybody trades. But between the euro yen, Aussie yen, New Zealand yen, Canadian yen, Mexican peso, Japanese yen, those are all big carry trades that are being unwound in the markets. And so this is the yen futures contract that Jim has brought. But if you have to imagine, it's not, the dollar index doesn't really, the dollar index doesn't move around the yen. I always tell people the dollar yen is its own animal. The dollar index is more affected by what's happening with the euro dollar and the pound dollar, or the, dollar Canadian, something like that. But the yen itself, it may be a fairly sizable percentage of the dollar basket for a single currency. But the yen that you see here that Jim's pointing out really has so many other countries involved in it that make up this one.
All the cousins, so to speak. Again, the dollar index, the yen is 13% of that total.
Right.
The euro 57. So that, just the math itself. The yen carry trade, just very quickly, the Bank of Japan kept rates at zero or below zero from like 2016 until not that long ago. And so people could go over there, borrow money very, very, very cheaply, and then potentially, and more likely, sell the yen. Well, that was in part why it went through this major decline. It was like a source of borrowing, but also selling the yen, converting it to other currencies to buy U.S. assets, to buy mega cap stocks, and so forth. So something that's been around that long, and as you just noted, there are other carry trades tied to the yen with other currencies. It just doesn't go away in a few weeks. That's been in place for 7 or 8 years. We're talking huge amounts of money. So that logic and understanding, I think, all right, adds some credibility to the yen chart. Like, it's probably not completely unwound. The chart implies that it isn't, and that the yen is going to have another push higher. And we know what the impact is likely to be on the other financial markets.
Right. Okay. Well, Jim, let's get to the dollar, because the dollar is your next chart up, and tell us what you're looking at here.
Well, for quite a while, the expectation was it would drop to 102.5 or a little bit less. It got down to 102.16. I think, we've talked, Blake, big triangle. So the top at 107 over there on the left was wave A, down to 100 and change for B, the high at 105 580 or 106, whatever it is, was C. And I think the spike low we saw on Monday was wave D. That implies we're in wave E, and it will retrace, a portion of the decline that we saw from the high in April. And my guess is it could get up towards the 104.80. It should be a three-wave rally, a rebound, up, down, up. If this pattern analysis is correct, and we get a wave E, the next is that there's a big decline coming in the dollar index. And again, my take is and has been, as the economy, U.S. economy slows, it was going to be negative for the dollar index. And that view hasn't changed. And so, we get a bounce, and it could last, I don't know, 2 to 4 weeks, maybe even a touch longer. But ultimately, if this triangle pattern is correct, it'll be a great short trade setting up in the dollar and being long a lot of other currencies.
Yeah, and I know a lot of people have a hard time like understanding how that is going to happen, especially if there's a recession and stocks, come under pressure. How's the dollar going to go down? But the correlations can change and they shift all the time. And I have to remind people, if you go back to like the dot-com bubble and when stocks were coming unglued at the seams back in 2000, 2001, 2002, the dollar declined with it, for a big chunk of it. So
maybe
that
one
can
of these
happen.
weeks. One of these weeks I'll bring a real longer term chart of the dollar index, Blake, because I've written about this in the past, where everyone's focused on interest rate differentials and all that. But quite honestly, whatever an administration in the U.S., whatever their position is, and if it's clearly stated, that has had great impact on the dollar. So the dollar, when Reagan came into office, the dollar rallied huge. It's hard to believe. It got to 164 or 65 in February of 85. And then the Plaza Accord came up, intentionally lowering the value of the dollar. And by late 87, it was down to 85. So anyway, we're not going to do it now, but it's interesting because, Trump and Vance have talked about, and Trump did this back in 2016 because I wrote about it. It's on the surface, a strong dollar sounds good, but you know what? In the real world, it really isn't. I'm paraphrasing. So he definitely is one who, I'll use a depreciating dollar to help U.S. businesses sell more goods overseas and so forth. So anyway, we'll see what.
We'll see. We'll see. It's going to be a few months. So that's for sure.
Long 3 months.
All right. Well, gold is your next startup.
Anyway, here we go. Okay, gold. This is one of those things, like I said at the beginning. Sometimes it's like, all right, last week I thought, geez, okay, we're getting set up. This pop, and it could be that rally to 24.74 is wave 1 of 5. The pullback we saw is 2 of 5, and it's ready to blast again. So I guess ultimately, I think the gold is going to go above 24.81. But I still think there's a decent chance we'll see gold dip under 22.88 before this sideways congestion, which has been in place since April, is done. About a month or so ago, I showed you a chart of positioning in the gold, and it was heavily long by large speculators, like more than 250,000 contracts. Over the last 10, 15 years, whenever that position has gotten that extreme, gold has dropped 20%. So, I'm looking for about a 7% pullback or whatever it would be, maybe 10%. Yeah, under 22.88. That's not that much. So my point is, I'm not sure what gold is going to do in the near term. Obviously, as long as it holds that trend line, the upside is still possible. I just don't have conviction to say, yep, it's time to buy gold.
Yeah. Okay. Well, you know what? It's okay not to have conviction. I mean, I wish I had conviction 24 hours a day, Jim. My trading would look a lot different than it does. So, I mean, because you would just be, going, full into
crazy
positions, I mean, it's just a lot of times we have to massage our areas around the market until we get conviction where we can, take bigger
Yeah.
positions. And I mean,
Yeah. One of the worst things someone can go to is from conviction to cocky.
yeah, right. Exactly. Exactly. Exactly.
All right.
Well, Jim, next chart you have is TLT. Speaking of being cocky, I mean, maybe the bulls are getting a little too cocky, with this move that we saw. What do you say about where we're at?
Well, again, my take for quite a while has been, hey, we're going over 100.57. That the rally from last October's low at 82 and change to 100 over 100 was A. We got the decline for B. But the move up has been so choppy, and I can count 3 waves up to 94 and change, a drop down to 89 and change, and then another 3 waves up to the high we saw on Monday. It's like, okay, is that some kind of a big ABC? And we're going to see another pullback that maybe tests that black trend line, the rising black trend line, before we make the move up. I honestly don't know. I'm entertaining these thoughts, A, because of the depth of the pullback that we saw, 5 points in 3 days. I mean, that's serious. So in other words, that shows you the conviction that people had as, oh, we're going into a recession. Oh no, maybe we're not, and the bonds got hammered. From a chart standpoint, that breakout near 95 is classic. Broke above it, came back to retest it. And so to me, it's like, okay, that stops should be at 94.84, or maybe a touch less if you want to give it a tiny little bit of room.
Right.
But to me, so chart-wise, this implies that there should be another rebound. It should get above the high we saw at 99 and change on Monday. But I have to just admit, I'm like, whoa, I didn't expect to see it drop 5 points in 3 days. Even though I thought that people were wrong about the recession call, I was just amazed at what we saw. So if the yen goes up again, bringing the yen back into the picture here, that would be bullish treasury bonds, because
and if the yen gets a resurgence, it tends to be when the dollar yen, like if bonds are going up, yields are going down, that means the yen is strengthening. That means the dollar yen's going down. That's a correlation that's pretty tight. So that's what you're saying.
Yes. Yeah. And it's been tighter, obviously, the last month or two. Since early July, the yen bottomed, and, the treasury bonds have been rallying since that low in early July at 89 and change.
Yeah. Well, Jim, before we get into the last chart that everybody's waiting for, they're waiting for the S&P. I just want to remind everybody, Jim does this for you each and every week, and if you do appreciate him, give him a thumbs up. And Jim, how should they contact you?
Jim Welsh Macro at Gmail, and I'll be happy to send a recent publication, or go to macrotides.com. I will tell you one thing, Blake, which is kind of nice. My retention rate on people who subscribe to my letter is well over 90%. And, so that to me says, you know what? I think I'm providing some good analysis for people.
Yeah.
And a lot of these people are utilizing it in their investing. And so that's my plug in terms of becoming a subscriber. I mean, we cover a lot of ground every Friday. I do so much more in the reports and detail and explanations and so forth. So check it out. If you tell me you're from Trader Summit, you'll get a discount.
Awesome. All right. Well, Jim, low attrition is always a great sign, and that's a hallmark.
Unfortunately, it also applies to my waistline.
All right, Jim. What are we going to do with the S&P here? I mean,
I mean, last week I put there, 8.2. Okay, 3 waves down and 3 waves up to that 55.66, and okay, I think we're going to 52.87. Well, obviously, we blew through 52.87.
Right.
As I said earlier, finding wave 3, where most of the energy is, whether it be up as it was in the yen, or down as we saw the S&P peeled off 400 and some points in 2.5 days.
Yeah.
So to me, that looks like wave 3. All right, if that's wave 3, how does that fit into the old picture? And to me, what it implies is, and this is a more bearish outlook, 1 down, 2 up, then a 1, 2, 3, 4, the bounce we've seen since Monday morning is a wave 4. We've gotten above the high of wave A today, above 53.30. as long as we don't overlap 53.91, because that was the low of wave one over there. So that still leaves the door open for the S&P to go down and take out 51.19. And so to me, I'm leaning that I think that's going to happen, because I think the yen is going to rebound. And if it does, I think we'll see more weakness in the S&P and take it down to a lower low. And then I think you're going to get another pretty good rally back to whatever the high is that we've seen, whether it's today's high, if it goes a little bit higher or not. So that's my bias. Because of the yen, I think we're going to go down and take out 51.19. And, if that happens, it starts to, in my view, lower the probability of the S&P going to a new all-time high.
Okay.
Doesn't eliminate it, but it lowers it.
I was just going to ask you, because last week you still said there is a path to go to all-time highs. And so there still is, even if we take out 51.19.
Yeah.
But it's just not as high probability.
Yeah. I mean, last week it was like, hey, we get below, we get down towards 52.87 or whatever that number was. Then it was like the two legs would be equal. Well, we blew that through that.
I mean, you couldn't anticipate the Nikkei was going to be down 12%.
No. But when things like that happen, one has to stand back and say, okay, this is what I thought, but maybe things have changed. And I think things may have changed. And so, if the S&P goes down and takes out Monday's low, it just adds to that analysis. If instead it takes out 53.91 and we get a three-wave pullback from that, then, new highs are back on the table. I don't know what the market's going to do with certainty here. And that's what I said earlier. Sometimes it's like, okay, let's stand back. These are the parameters that provide us more information. But the market has to kind of define those parameters.
Yeah, and I want to remind everybody now. I know you're going to be watching this over the weekend, so you're not going to see this before the market closes. But there are geopolitical risks surrounding this market, and the Ukraine-Russia situation's intensifying right now, and that makes sense to me because I know winter's coming. So it's like if we're going to make an offensive, it's got to be like here now. Then you've got the Iranian-Israeli situation. Does it drag the U.S. into it? I mean, there's a lot of things that can go wrong. Not saying they will. I'm just saying there's a lot of risks out there. So, Jim, I think when you take market moves and you see them, a lot of times things don't. Well, a lot of times for me, and I know for every trader out there, things don't come to plan the way you originally saw them happening. Yep. And so then you have to reevaluate and reassess and come up with a new plan. It's just how things work. I mean, because we're not fortune tellers, we're risk managers. And so I think it's good that you're like, okay, what happened on Sunday, Monday in Japan. Now we have to reevaluate what are the probabilities of other things going on. And I think you've done a good job with that. So Jim, I want to say thank you for being here and walking us through everything every week. And the accountability from week to week is immeasurable and awesome. And I'm hope everybody at home appreciates it as well.
Thanks. Have a great restful weekend, Blake, and get ready for next week because I have a feeling it's going to be a little nuts next week as well.
We got inflation. Holy cow. Stop throwing stuff at us.
I'm so glad you mentioned it. The takeaway values are like 21 and 23 basis points from the headline and core. So there's the room. I mean, last month, I think the headline was actually down 0.1 and the core was up 0.1. So if they're both up 0.1, the headline and core will downtick slightly. Is it market moving? It's nice. I don't think I think there's other things going on, and we've addressed it in terms of the yen. Is the yen more important than the CPI right now? Yeah.
All right. Very good. Well, Jim, thank you so much for spending your time with me, guys and gals. If you enjoyed Jim's, his sermon, make sure you jump down below, give him a thumbs up. Also, subscribe to the channel. It's free to subscribe, and it's also free to hit that bell icon because if you do that, you're going to get notified whenever there's a new interview with Jim Welsh. and you'll be one of the first ones to listen to it. So make sure you click that bell icon so you'll be notified over the weekend when it does come out. Jim, I want to thank you for being with us. I know you're going to have a restful
My
weekend
pleasure.
with your wife,
Yep.
and I hope you enjoy it. So we'll see you next week.
Thanks, Blake. Take care.
You too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.